What's going on, everybody? Zach Macmillan back with you again for Let's Talk Mortgage. Been going for a little bit, but I guess y'all probably won't be able to tell a difference because it's time lapse. But either way, I'm back again. Let's Talk Mortgage. This time, got a special episode for you. We're talking about credit, specifically credit cards. How can they help you? How can they hurt you? Everything on here is Let's Talk Mortgage. So we're going to talk about how can it impact you when it comes to refinancing or purchasing a home. So stick around. Let's do it. So the reason we're talking about credit cards specifically is, of course, when we go to pull your credit report, when you go to purchase a home or refinance your home, we all looking for a credit. We all looking for a good credit score. We're looking for established credit. We're looking for good pay history. We're factoring in these things when we're trying to get you pre-qualified and pre-approved in order to get purchase a home or refinance that home. So the reason why I'm talking about credit cards specifically, credit cards is one of the easiest ways to establish some credit history if you don't have any. Now, of course, there are those programs that allow you to purchase a home using what's called non-traditional credit, in which case we're using things like your on-time rent payments, your on-time utility bill payments, on-time internet payments. So we do have those things when it's called non-traditional credit we can use, but it doesn't, it always helps you if you have some established credit already. With that good credit score, so you get better interest rates, access to better programs, or I won't say better programs, but more programs when it comes to purchasing and refinancing. So it doesn't necessarily hurt you when you have some of that established credit history. In doing so, one of the more popular or more prominent things that you see on credit reports and you see people using to establish credit history is credit cards. So that's what we're talking about that today on this episode. Now, first things first, I am not telling you to go out there and get a whole bunch of credit cards. That's not what I'm telling you to do. I'm not teaching you about any hack to use to help boost your credit score using credit cards. I am no type of credit repair expert, no type of credit expert. I'm just a licensed mortgage loan originator who looks at people's credit history often and help them determine whether or not they can qualify for purchasing a home. But the reason why I'm talking about credit cards is, like I said, it's one of the easiest ways to establish some credit history. So just doubling back around, I'm not telling you to go out there and get a whole bunch of credit cards. That's not what I'm telling you to do. But if you are trying to establish some credit history, getting a credit card is one of the easiest things you could possibly do to establish some credit history. Now, I know there are a number of the online systems you can use where you lend a certain entity your money and buy stuff with it and you make payments. And there's a number of these online options that's been made available a lot more recently to help you establish some credit history. The reason why I'm talking about credit cards specifically is because of the different factors that go into having a credit card that benefits you in terms of beneficial or can hurt you in terms of refinancing or purchasing a home. So let's talk a little bit about some of the details about that. So one of the benefits that credit cards give you when we're looking at a credit report, and I'm going through a credit report with the borrower, one of the benefits that credit cards give you is length of history. So what happens is you may have a car payment, which is an installment account. You may have a student loan payment, which is an installment account. You may have a personal loan out there, which is an installment account. And what I mean by installment account is they have terms on them, a 72-month term, a 100-month term, a 50-month term. So they have these terms on them in which that at a certain point, these installments, these loans will be paid off at a certain point. And so, which is why you will see where if you pay off your car, right after you pay off your car, your credit score may take a little bit of a dip immediately. The reason why that is the fact that that installment account, that 5 years you had that car, that 5 years you were paying for that car, those 4 years you were paying for that car, you were making those on-time payments. And so it was reflecting good pay history, good credit history, good established length of credit in regards to that installment account. But what happens when you pay it off is that account now closes, and therefore you still have that good pay history with that account, but it's not reporting any longer those on-time payments. Has now been closed out, and therefore doesn't hurt you, but it doesn't do you any good in regards to showing good pay history, good established history, because that account is no longer established. It's closed now. So that's why you may see that one on those established accounts, those installment accounts. Excuse me. That's why you see it on those installment accounts where after you pay them off, it may hurt your credit for a month or two, and then start to build back up because that account you were paying for 5 years, 6 years is not closed. And so the thing about credit cards is it's not an installment. It's not an installment account. It's a revolving account, which means there is no term attached to it. It just goes on as long as you keep it. So when you start a credit card, you can have it for a year, 5 years, 10 years, 20 years, however long you keep that credit card, you can have that established history with that credit card. And the reason why that benefits you is one of the factors of having good credit is length of credit history. It's good when we can see back that you had an account for 10 years and made on-time payment for the past 10 years on an account. And that's one of the benefits that credit cards can help you with, and establish that good credit history over a long period of time. And that account doesn't necessarily close unless you close it. So that's something to keep in mind when it comes to credit cards, okay? Now, along with having that long-term effect of on-time of payments you can have with credit cards is the point that you don't, I don't want to use the term never, but you don't want to close your oldest credit card. If you ever talk to a credit advisor or someone who helps with people's credit or reviews people's credit profile a lot, they'll always tell you, always leave open your oldest account. And the reason for that is, like I just said, it shows that longest length of pay history, that longest established account available within good standing. So you never want to close your oldest account. So if you have 3-4 credit cards and you want to kind of consolidate, you want to scale some back, you want to leave that old account open as long as possible, even if it's only a $500 limit, a $200 limit. You can just spend, $15 on there, $10 there at a time, and then pay it back off. But you never want to close that account, because that account is probably what's holding up your credit score as much as possible, because you had that credit card for the past 5 years or 10 years or however long you had it. But those older credit cards, those old accounts, you definitely want to hold on to those as long as you possibly can. Which brings me to a very important point about credit cards. And this is for, I guess, the younger individuals who don't necessarily have any credit cards, or if you don't have any credit cards, period. You want to be careful about or mindful or smart, whatever term you want to use, in regards to what credit card company you go with or what option you choose. Now, if you don't have any established credit history, your options may be limited, which I completely understand. But you do want to at least exhaust your resources in doing your due diligence to find out which option may be best for you. And the reason why I make that point is because of the fact I just said in regards to that long established credit history. Whatever your first credit card is, you want to make sure it's a company or a credit card entity that you will be able to sustain for 5 years, 10 years, 20 years, what have you. Someone you know is going to be around for a while. Someone you know that you feel comfortable working with, having that credit card through. A couple good points of things to keep out for is this credit card company that you have, whether it has certain perks that go along with it, like points you can earn, cash back that you earn with this credit card. The other thing to keep in mind is this credit card company that you're going with, what's the highest available credit limit they're able to offer? And if they offer you a lower amount, how often do they get a chance to increase your credit limit going forward? Do they have to run your credit when every time they want to increase your credit limit? So these are different pieces that you want to keep in mind when getting a credit card. And like I said, you want to do your due diligence to find out exactly what different perks or benefits, or whether or not this is going to be useful for you over a long term, because this credit card you're about to start, this new one, this very first one you have, you want to have it for at least 5 years, 10 years, a long period of time to help build up that credit history for yourself, okay? So now that you have this credit card that you have for the past 5 years, 10 years, however you've been using it, they increased your limit's now 10,000, what have you. When you get ready to purchase your home or refinance your home, and this goes for if you already have a home and buying a second home, or get ready to buy your first home, whatever, in preparation for purchasing a home, you want to be paying down your credit card balances. The reason for that is the lower your balance, the lower your payment. As mentioned before, or let's pretend as if you didn't watch that episode, we're going to factor in your credit card payments into your debt to income ratios when we're getting ready to qualify you for purchasing a home. So the higher your balance is, therefore the higher your payment is, and therefore that more is going to cut into how much home you can afford. So you're going to want to pay down your credit card balances in preparation for purchasing a home. I'd much rather you, and this is me talking personally, if you have to decide between paying down your credit card balances or paying down any type of debt that you have on your credit report and saving money, I almost prefer you to pay down your debt because, like I said, it's going to make room in your debt to income for purchasing a home rather than saving money. And the reason why I said it is if you are a first-time home buyer, by paying down your debt is making room for how much home you can purchase. And by doing so, it's going to increase your credit score. And therefore, we may be able to get you qualified for some down payment assistance, or we may be able to get you qualified for some type of grant program that some banks will offer, or we may be able to get you qualified for a 100% financing program. So there are means if you're a first-time home buyer to help you get funds. If you have that credit score and you paid down those debts, there are means to those things. And also, if you already own a home, hopefully you're just going to have enough equity in your property that you're selling to be able to use for a down payment anyway. So I'd much rather you pay down those credit card balances to help lower that DTI so we can be able to qualify for more of a home when you get ready to purchase. Same thing when you get ready to refinance. That part's a little bit different. I still rather you pay that balance down unless you're getting ready to pay those balances off with a cash out refinance. And we'll touch on that in a second. But unless you get ready to pay those balances off with the cash out refinance, I still rather you pay that balance down to help increase your credit score. Because when you're doing a refinance, we're still going to want to get you the best interest rate possible. And by having a better credit score, it's only going to help that. So keep that in mind, okay? So I said something just a second ago about cash out refinance and paying off your credit card debt. Just real quick, this is going to be covered on a different episode, but a cash out refinance is when you refinance your home and take cash out using the equity that you have in a property to use those funds to do whatever with. So essentially, I said that you can pay off your credit cards using that cash out refinance, which you can do. I have done that before, and it's actually a smart way to help consolidate some debt, especially when you have these higher credit card limits and you find yourself with a $10,000 credit card balance, or $15,000 credit card balance, $20,000, whatever have you, on a 17% interest rate, 20% interest rate, whatever that rate is on that credit card. You can do a cash out refinance and pay off that credit card balance and pay a lower interest rate on your mortgage because it's spread across that 15 years or 30 years rather than paying that 17%, 19%, 20% interest rate you're paying on your credit card. So you can do that with a cash out refinance. So you may not need to pay off those credit card balances if you are essentially going to do a cash out refinance and pay those balances off because it's going to eliminate your debt to income anyway. So that's something to keep in mind for that option, okay? So in retrospect, into credit cards being one of the best ways to build and establish some credit history, is also the easiest way to get yourself in a financial debt that's hard to get out of. It's so easy to get these credit cards with a $5,000 balance, a $10,000 balance, and just think, okay, well, it's no problem. I'll just pay it off over time. Many of us have said that, and not to say that it does not work, but it requires some due diligence in regards to paying that balance off. And sometimes that hole you dig in that credit card balance that you have is a lot harder to get out of once you get down in there. So keep in mind that even though I'm saying that credit cards are some of the easiest way to establish some credit history, you also want to know yourself and whether or not you're responsible enough to handle having a credit card. I talk to a number of people and they just say, you know what, I don't want a credit card. I don't want that type of responsibility of having $5,000 available like that $10,000 available like that, accessible to me to just go out there and spend. I know myself well enough to know I can't handle that. So if that's you, that's perfectly fine. There are other ways to establish some credit history that's a lot more restrictive, that's a lot more easy to manage. At the same time, like I said, it has its pros and cons, so it can benefit you, but it can hurt you a lot as well. So you definitely want to weigh the options of whether or not having a credit card is going to be good for you and one that's going to be detriment to you. So you want to keep those two things in mind, okay? So there you have it, ladies and gentlemen. Some quick information about credit cards and credit per se, how it can help you purchase your home or help you refinance your home, whether or not it could be a detriment to you. And so I hope this information was useful as possible. As always, if you have any questions, feel free to reach out to me via email or messenger or phone call. We definitely want to be there to support you all. I look forward to talking to you all again right here on Let's Talk Mortgage. Let's buy a house or refinance it, whichever you want to do. I'll see you next time.